All right, guys, we're going to start in 5 minutes, okay? 5 minutes and counting. All right, good morning, Checkmate crew. It is 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern Time on this Thursday, December 15th, 2022. It's yours truly, Mickey Blindside here with your market memo. Okay, so guys, today is day after FOMC. All right, they raised 50 basis points. No surprises there. I know that right now there's a negative reaction in the market right now. I think it has to do with some of the data dumps that happened this morning, and we'll go over that soon. But as far as yesterday's FOMC announcement, it was like a big nothing. Even the bond market really didn't do all that much. If you actually look at the Fed funds probabilities, they did not shift all that much. We're still expecting a 25 basis point rate hike for February. We're still expecting a 25 basis point rate hike in March. But the Fed funds futures market, what did shift, however, was that instead of a potential rate cut, 25 basis points in September, the odds of that decreased a bit, but it looks like it's going to get pushed more into November. So, that's the only small change that I've noticed in the actual Fed funds probabilities. If you actually look at some of our other rates, for example, the 2-year, really didn't change all that much yesterday. Okay. And that's what, usually after an announcement, we actually see a bigger reaction in the 2-year treasuries. If it were to be super hawkish, for example, the 2-year would have spiked up, but it didn't. It spiked. Well, initially it did, but then it actually closed lower for the day after the announcement. Okay, the 2-year yield would have spiked up, but we didn't really see that happening. So there seems to be a disconnect between what the Fed is saying and what the bond market is saying. It seems as if the bond market is pretty much saying that the Fed is nearing the end of its tightening cycle. All right, the bond market doesn't believe. I mean, people were saying yesterday, even in our Discord, if you look at social media and other places, everybody was saying that the Fed was hawkish. The Fed was hawkish. The Fed was hawkish. Well, was it really? I mean, and it doesn't really matter what you believe or what anyone believes. What the tone of the Fed is, it's what the bond market's reaction is, and the bond market really didn't. Again, the 2-year yield actually dropped yesterday. Okay, so that just tells you it was a big nothing. Okay, and so even it doesn't matter how hawkish you think the Fed is, the bond market just doesn't believe it. Okay, the bond market is signaling to us that we're nearing the end of the Fed's tightening cycle. Okay. Fed funds probabilities are saying the same thing. I mean, these are big market participants, okay? And so this is big money here we're talking about. We're not, this is not some like retail can come in and change this. No. This is not like that. Bond market is way larger than the stock market is, way larger, okay? And so that's at least what the bond market's reaction is to yesterday's FOMC. Now, today we had some data dumps today. First of all, jobless numbers came out, and right as those jobless claims came out, the market dumped. The S&P 500 and such dumped after that. The consensus was that there was going to be 230,000 jobless claims. In actuality, there was only 211,000, which is actually a drop. It's about a 10% drop from the previous number. Okay, so I think that is what's causing kind of this VIX spike, S&P 500 drop today. I mean, it is what it is. Look at that. We're already close to 3,900. Okay, we've got some major put walls. I mean, we got put walls at 4,000. We also got put walls at 3,900. So for those of you watching along, and if you guys are inclined to degen and gamble, you may want to, day trade here. 3,900 doesn't seem like a bad risk to reward, or not a bad reward to risk setup for a day trade long. But I'm not going to be doing that. I'm right now. I'm doing this out of state. I'm traveling right now, so I don't really have all my screens and everything. So, I'm going to just take it easy. But for those of you that are day traders, you may want to consider doing that. again, you know how I feel about day trading. I think it's going to be a lot easier just to wait for a better setup down the road. So I am waiting patiently for that. Okay. ECB also had their meeting today as well too. They raised interest rates by 50 basis points as well. And they actually signaled to the market that they're going to slow their rate hikes. So the ECB is already starting to shift their tone, so to speak. Bank of England also said that they were going to temper their rate hikes as well. So, right now I think there's this common theme amongst global central bankers right now that they want to ease a bit. Okay, it just seems like that's kind of the theme here. Bank of England, ECB, the Fed. They all seem to be coordinating in their messaging. Not that they do coordinate or anything like that, but they do meet and they do have a line of communication amongst them. So perhaps they're getting pressured to ease off a bit. And again, the bond market is already kind of telling us that they don't really believe in the Fed hiking rates faster. They already the bond market showed us that the Fed was going to slow down their rate hikes, and now already again they're already pricing in a rate cut for next year. Okay, and nothing has changed. Even after this FOMC, nothing has changed. Okay, so again, guys, look at the data. The data is telling us this. Everybody's saying that this is all because of the FOMC, the sell-off in the S&P 500. I don't really think so. Could we have a pullback? Yeah, we could. And there's really nothing to say that that we're going to see new lows or anything like that. I don't see any data supporting that. However, let's look at our liquidity data. Okay. So for our junk bonds advanced decline line, it is still going up. Surprisingly, okay, it's still going up. We still have that data divergence. We have junk bonds advanced decline line going up, and I've even done a whole episode around why we look at the junk bonds advanced decline line. If you hit the top right hand corner, there should be an exclamation point. I'll put a link on there. If you're watching our recording, I'll put a link to our special session where we went over the junk bonds advanced decline line. But we're also seeing some divergences. New York stock exchange high-low line, it is curving down. So again, when this is curving down, that just means that we're going to continue the bear market. This is all just a bear market rally. Usually we do not see sustained rallies unless this curves up. I do think in the next 2 or 3 sessions, this data divergence is probably going to come to an end. Okay, something is going to have to move. Either the New York high-low line is going to have to move up, or our junk bonds ADL is going to have to start curving down again. Okay, we shall see. All right, and generally the broad market reaction to the FOMC can take a couple of sessions. Generally, it's not just right after the FOMC where we have this reaction. We sometimes see it the day after, sometimes 2 days after, sometimes it's the Monday after that where we see the real broad market reaction. So let's wait. Okay, so I do think in 2 or 3 sessions we're going to see something's going to happen. Okay, so either we're going to see this curve up, the New York high-low line curve up, and then the junk bonds ADL line was right, or we're going to see this continue to curl down, and then our junk bonds ADL is probably going to start curling down in the next 2 or 3 sessions as well too. Okay, and if that's the case, hey, bear market continues. Okay, but until then, this is still a bear market rally. Okay, in my book, this is still a bear market rally. We don't know yet, when this is going to be over, but I do think at some point, we've also noticed that the VIX has been spiking and making these large outsized moves on slight pullbacks, sometimes even going up when the S&P 500 goes up, and I think that's a setup to a rolling bull market a rolling bull market, I think, but it's going to happen probably around January, February, or past that, okay? It does take some time in order for all the data and all of the markets to kind of get into that scenario, but the setup is there, okay? It may not happen, it may collapse, but the setup is actually there. I'm not trying to predict the future, I'm just anticipating what could happen. So we shall see what happens in the next couple of months, but I do think we see a rolling bull market maybe in the next 2 or 3 months, and our data will show us this, but not yet, okay? So not yet. Until then, though, hey, we might pull back. We may, I highly doubt it, but we could make new lower lows. Okay, we could before that happens, okay? You just got to keep an open mind about it. It's all a realm of probabilities, okay? But right now we do have a data divergence. I want to see this data divergence over before I start calling out what's going to happen in the future, okay? So I'm going to be watching this very closely. New York AD line, the advanced decline line of the New York Stock Exchange, curling down again, trying to make lower lows. So now it made a lower high, lower low. Now it's in a downtrend, okay? If it closes here. If it closes here for the day, we are going to see a lower high, lower low. We're going to see a daily downtrend again on the New York Stock Exchange advanced decline line. So it looks like New York advanced a New York Stock Exchange advanced decline line and our New York high-low line, they are agreeing with each other. So there's no divergence between those two. The only divergence is between all of our, I guess, liquidity data from the stock exchange versus junk bonds. Okay, so there is a little bit of a disconnect. We'll see who wins in the end. Okay, so equal weighted S&P 500 also is not as bad, actually. The equal weight, is still relatively flat since November. All right, it's not the same as the S&P 500. I think S&P 500 since November we've been going. No, actually, it's about flat. So it's about the same. Okay, so it looks like the broad market is selling off mega cap and all the lower cap stocks. They're all selling off equally. So there's no divergence there. But okay, so yeah, so our liquidity signals, they're not clear at the moment, and I think that has something to do with this options expiration as well too. So let's get through this OPEX, let's get through this quad witch, and then we'll see where the dust settles. Okay, so that's where our S&P 500 is. Let's talk about other things too. One thing I noticed is the Australian dollar, the Aussie dollar right now is close to our make or break level. Let's go through all of our currencies actually, but let's start with the AUDUSD. So this is not where I have all my supports. Okay, so let's go to AUDUSD here. All right, so AUDUSD, Aussie dollar, this is our make or break. Remember, this was our make or break for quite a while, actually. We had these levels drawn since around July or so. This was our make or break level from July. It tapped there, it went up, and then it broke down in September, and we saw metals collapse. We saw Chinese stocks also really have a big sell-off with this. And now, as the Australian dollar went up in the last few weeks, we saw the metals come back. We saw China come back. Now, look at this. If we close below this, okay, if we close below this for the week, okay, so not only today, but tomorrow as well, that could be a setup for us to see the Hang Seng and all the other China-related indices have a pullback. Okay, this was a monster run. Okay, almost a 30% run in the last month and a half. In the Hang Seng, okay, so we are due for a pullback. Well, when anybody that says we're due for anything is usually about to lose a lot of money. So don't ever think that way. But we could see a pullback. Okay, you can't just have a 30% run and not expect to have a pullback, right? So I think it's fine. Do we make a new lower low? I don't think so. I don't think that's the case. There's no data to support that, but we could see a pullback, especially if the Australian dollar closes below that make or break level in the next, in the next 2 sessions. If that happens, we could see a pullback in this. I do think, though, if the Australian dollar pulls back, whether or not we get into our Chinese names is if are we still going to hold certain levels, okay? I think if we hold, okay, if we can hold this kind of like this 640 level, this 0.640, if we can hold that, and it bottoms there, the Australian dollar bottoms there, that will be our signal to get long on Chinese stocks, okay? And what I want to be long on. I want to be long on ZTO, okay? ZTO. I've done a whole segment on this back around Thanksgiving time. I had a whole thesis around ZTO. They had great earnings last round. They got free cash flow growth, EPS growth. They're buying more of their stocks. They're doing more aggressive share buybacks. I mean, what else can you say? It's a great stock, okay? It's the FedEx of China, all right? So I think this is the name that I want to get into. If we do see a pullback, we see the Australian dollar make that bottoming around that 0.64, 0.65 zone. I would expect that ZTO would probably pull back into the $20, $22 range. I would really like to get it as close to $20 as possible, but if I see that Australian dollar is bottoming at 640 and we're at 22 or so, I'd still be a buyer right then. And again, what I'm going to use is I'm going to be using leap strategies. Okay, so I'm going to be using the 400-day, the 1-year leap. All right, and then I'm going to be selling some covered calls against it, doing a poor man's covered call. So that's my plan, at least for China. And I'm going to be using the Australian dollar for that. But let's look at some of our other currencies that we're looking at here. EURUSD pulling back a bit. Also, the British pound. So these have been really good indicators for us for risk on, risk off. I do think that there's still a lot of overseas cash in dollar-denominated accounts. All right, and so as the interest rates of those, if we see it leveling off, we could see the British pound and the euro advancing. Now, could we see a pullback in this? Definitely. And if it does pull back, I do think that's going to be a risk-off signal. Probably the market's going to go down a little bit. S&P 500, all that is going to go down if that happens. But if it bottoms out again here, right, let's say, for the British pound, let's say around this like 1.15 or so, let's say it pulls back and it bottoms out and keeps going up again, that would be a risk-on signal. That means a lot of those dollar-denominated accounts, they're selling dollars, buying their local currencies, and then buying assets. One of the signals that is going to really help us with that as well too is the ZF, okay? And the ZF is the 5-year Treasury note futures. If this keeps going up like this, that means the 5-year yield is coming down. If the 5-year yield is coming down, there's less of an incentive to keep that money in those overseas dollar-denominated accounts. All right, so I think as long as ZF doesn't make a lower low, that phenomena is still going to happen. There's still a lot of cash in those dollar-denominated accounts out there, and so I think again, if they sell those dollars, buy their local currencies to buy local assets, then we're going to go back to risk on, and I do think that this is just a temporary pullback. I mean, it may last a couple of weeks, and it may be scary, but the data will show us the way. Okay, let's give it time to give us that signal. All right, just be patient. Okay, patience. All right, patience and discipline. Okay. Speaking of the dollar is up today. The dollar. Well, the dollar index is a little bit down there, but the dollar futures is up. That's strange. there's a little bit of a divergence here. I'm going to go with the dollar futures. When in doubt, go with the dollar futures. This is actually tradable. The dollar index is not. So we're seeing the dollar futures going up. And, you know, rightfully so, as we're seeing all these other currencies selling off. It doesn't make sense that the dollar index would be flat. But yeah, so we're just seeing the dollar going up. We still have our UUP call position. I do think that we're going to go up, but I don't think we're going to make, you know, like huge highs or anything like that. I do think that if we get to this like let's say 107 zone, that would be a good place to take profit on our UUP call position. Okay. Let's see, in the dollar index, does it actually show up as around the same? Yeah, it would be around the same. 107, 109 is our levels on the dollar index. It's very similar, 107 and 109-ish. 107.7 to 107.8 to 109.5 zone. Okay, those are my two take profit zones. And again, if the dollar tops out there, it makes a on a weekly chart a lower high. Okay, on the weekly chart, if you can make that lower high and then curl back down, that's when I'm going to start getting long on the metal miners. Okay, and you know which metal miners I'm looking at. Somebody mentioned PLG. I'm not interested in PLG anymore, just because I just want to be a little bit more selective in what I choose. PLG, I mean, it's a platinum development company, and right now they don't have any positive profits, and so I really don't want to be involved in anything that has a negative cash flow or anything like that. So I think I'm just going to stick with our ETFs, GDX, and more than gold though, I'm more interested in the silver miners. So junior silver miners, if the metal miners go up, the junior silver miners are going to roar. Okay, so I'm really interested in this junior silver miners, and I want to get involved in the leaps, the 2-year leaps, and sell weekly covered calls on it. And that's another great advantage of using some of these ETFs. Some of these ETFs have these weekly options, so you can start selling weekly poor man's covered calls against your in the money leaps. And I'm going to go over that more in detail as we get closer to that time. But definitely, I'm looking at silver junior miners, and we're going to try to get long on that as we see the dollar top out on the weekly chart, making that a lower high on the weekly chart. And if that happens, boom, we're going to get in. Okay, so that's my plan for the precious metal miners. What else did I have planned today? Our positions right now, let's look at some of that. XOP, we're still in XOP. XOP is doing quite well. Our spread is about 20% ahead right now, so that's good. I do think there's more ahead, actually. XOP, and again, this is part of our tax selling thesis. You know, we saw a lot of tax selling happening, in pairs, and so we saw some of the biggest winners and the biggest losers being sold off at the same time. And we noticed this about a week ago. And again, you can hit the top right exclamation point. I'm going to have links to where we had that. But if you look back in the last 2 or 3 weeks on our market memos, I mean, about a week for the tax selling. So if you look back for the last week, we've been talking about this. So shouldn't really come as a surprise. I do think there's more ahead. And again, if the TNX, if the 10-year Treasury rate keeps going up, which it's not right now, but if it does keep going up, that could intensify. Okay, I do still think that we could reach these levels, this 115, 116 levels or so. And again, we get out if it closes over this 139.46, which was the highs of this day right here. If it gets above that, we just get out at a small loss, and that's it. Okay, but I think the reward to risk is pretty compelling on this trade. Okay, so I'm willing to be patient and hold this down till we get to that zone. Once I get to around full profit on my spread, though, I'm going to get out. So that most likely, I mean, it depends on when that happens, but right now my spread is that 131, 121 spread, which is this one right here, the 131, 121. 131, 121 means that full profit is probably, I mean, if the closer we are to expiration, the closer it's going to be to 121. But if it happens, let's say next week or something like that, I mean, it would probably take up to like it would probably need like 117 or 116 or so to be in full profit. You know what? If it gets to around 75% of full profit, I'm just gonna take my profits. Okay, that's still like over 200% in profits. Okay, that's a profit rate of over 200% still. So there's no need to be greedy about that. I'm just going to manage risk once we get to that point. All right. Speaking of energy, what's going on in crude oil? Crude oil coming back down a bit. Again, this is going to be all based on the crack spread. I'd be guessing that RB is down. Yep, RB is down as well too. So gasoline, as gasoline comes down, the crack spread decreases. The economics of buying oil futures or oil to refine into distillates is just not there. So if this starts making a lower low, oof, watch out. And so you guys know how I feel about oil. I do think that oil is headed to or it's very possible. It's very possible that oil gets to its support, the oil to gold ratio. Gets to a support around here, which is the 0.037, 0.035, which corresponds to about $60 to $63 on the WTI chart. And so 63 on WTI would get me very bullish on some of the energy names. There are certain energy names that I want to get involved with. One of them is, as always, CPG. I want to get involved with CPG, but we'll see. Hopefully, it's a more speculative play. It's still increasing its free cash flow. It still has increasing EPS, all positive. They're increasing their share buyback and they're increasing their dividend. Great story. Junior oil miner. Okay, junior oil play. Okay, this is a junior oil play, so it's a little bit more speculative. Another name that I want to be in is AR. This is more of a natural gas play, so they might not be as correlated as to the oil markets. There is a decoupling that's happening in the oil and nat gas markets. So perhaps this was the pullback for the up move, but I do think that around January, February or so, there's going to be better opportunities in this space as we get, closer to the warmer weather months. Okay, I do think that there's going to be more opportunities then in these kind of names. Look at this. Oh, so yeah, so AR is more linked to natural gas. Okay, very good. So and rightfully so, as they're mostly in natural gas anyway. But sometimes when you see oil sell off, you see these natural gas explorers and producers also sell off too. But again, we've been noticing this. Well, at least I've been noticing this for the last couple of weeks. We're seeing this decoupling of those markets. So we shall see where that ends up. Okay. Nat gas going up again, cold snap. It just depends on the weather. The weather gets a little bit cold, boom, nat gas, the Henry Hub goes up. So I do think that this is going to be very random and up and down, up and down. I do want to see it come down just a bit. Okay, if we can see it come down just a bit more, I really was hoping for under 6. It was almost there. It was like 5% almost there, but it didn't quite get to my buy level for Boyle. Okay, Boyle is a name that I wanted to get into, but I think I'm a little bit too late on this. Okay. What else do we have here? I know some of you guys were surprised that I mentioned corn yesterday. Got a lot of DMs about this. And again, if we can see that it bottoms out around here, I'd be willing to take a trade if we get into sub 600s, okay, on the corn contract. It's not there yet. It's not there yet. I want to get as much value out of this as possible if I'm to take a trade, okay? There's so many opportunities right now. I just want to pick the best ones, right? There's no reason to waste capital on an opportunity that's not going to make sense or that's not going to pay us for the risk that we take. I really want as maximum value as possible. So there's so many good trades that are setting up right now. I'm willing to be patient for that, okay? Speaking of patience, let's see here. The oil tankers or the oil and natural gas tankers, still going up. It's there. I mean, every time there's a pullback, it just will not pull back far enough. STNG, rallying hard. They don't care what the market's doing. They're just going to keep going up. And again, it's just their spreads, their margins. Their margins are increasing. They got pricing power right now, okay? They've got some pricing power, okay? STNG, this one. I mean, this one is going to... Ooh, I'd love to see a pullback. I first started talking about this around here. I should have just bought right then. But it is what it is. Yeah, glad I got out of that. Okay, so that's that. Let's take a look at crypto. Crypto, the OI is actually decreasing. It's funny. We're at like 5.1 billion. We were at 5.3 yesterday. So it seems to me that that we're seeing some of these close out. Probably it's the options that are expiring for today. I'm sure a lot of people cashed out. Maybe it was because of the FOMC. Maybe people were gambling on the FOMC. Could be. All right. Let's see if there's any block trades. Were there any block trades today? Before, I didn't notice any. No block trades. So look at that. So as we see OIs decrease, we see less block trades or no block trades. Those block trades, 90,000, that's not big enough. I want to see at least $500,000 nominal sizes or more. So it doesn't look like maybe this was just a small little gamble for FOMC, and now we're going to go back into the fours. If that's the case, options are going to be, less useful and helping us determine what's going to happen. As far as the Ethereum price or Bitcoin price is concerned, I do think that we're probably just going to chop around here until we find clarity in the markets. If you look at Bitcoin and Ethereum, they've just been chopping around this zone after the whole FTX implosion. They've just been chopping around here. Just chopping around our value zone. Remember this value zone? This is where we entered our long from before. Okay, and we got stopped out at break even, but this is where we got long from before, and now it's just chopping around that zone. Okay, this value zone right here, and this is a value zone that we've had for a while now. Okay, this is a value zone that we had since the summer. Okay, so this is just chopping around here, and I expect that to be the same. Liquidity is so low right now. I mean, price could move a lot, but I'm not seeing any like large trades. If you look at Bitcoin or some of these other exchange datas, there's not really that many big trades happening. So I see that continuing, and if it does, I think we're just going to chop around here until we see a broader risk on or risk off sentiment. And again, our liquidity data is going to tell us all that risk on, risk off sentiment and what to do going forward. The last thing that I wanted to go over today was recession signals. Okay, I've been getting a lot of DMs. Are we headed for a recession? That's like one of the DMs that I've been getting for the last week or two. There's really nothing that I see that suggests that we're going to see a recession in the first half of 2023. And that's where everybody is saying we're going to see a recession. We're going to see a recession in the first half of 2023. I don't think so. Okay, there's nothing to suggest that. I do think, however, that we're headed for something bigger than a recession, not in 2023, but closer to 2024. Okay, I do think we're headed to something like that. And you guys, we've been talking about this since the summertime. As the dollar increases, that puts a lot of pressure on emerging markets and emerging market debt. A lot of the world's debt is denominated in dollars. So imagine the dollar is up 30%. You had debt. Your interest rates are going up. Oh, by the way, your debt has now increased 30% just because of the currency conversion, all right? This has really big effects, okay? And the effects are not felt immediately. Usually it takes years for the effects to happen. Now, the market is a lot faster now than where it was 20, 30, 40, 50 years ago. So I do think that the time where it's going to happen is around the end of 2023 or to 2024, closer to 2024, okay? That's probably when it's going to happen. That's also when I think that inflation is going to roar back, because inflation rarely is a one-stage, one-cycle issue, especially inflation where the core gets above 5-6%. That's not, you can't solve that just in one cycle, okay? It takes multiple cycles. Actually, you know what? Let me show you what that looks like. I've shown this chart before, but I think it's worth looking at again. Let's look at this. Let's look at the weekly charts. Yep. And let's go back. Okay, this is worth it. Okay, stick with me here, guys. It's worth it. Okay, so look at this. All right. Inflation is rarely, this is the 70s. This is the last time that we were at peak credit and we had this huge inflation. Okay, we had like, the core was at 10. I think headline was like at 15, 16%, something like that. So we had our first, I guess, episode with inflation in the end of the 60s, okay? In the end of the 60s, there was a lot of, in the 60s, there was a lot of stimulus, a lot of borrowing, a lot of expansion in the money supply. Surprisingly, we were also coming down from a major world pandemic, the Hong Kong flu, kind of like now. We were coming back down from pandemic, a lot of stimulus, a lot of money expansion. It's funny, every 50 years or so, this kind of human behavior kind of repeats itself. Before that, it was the World War I era. There was inflation. There was we were coming down from Spanish flu. 50 years before that, it was the U.S. Civil War. And around these peak credit moments, we also see increased global conflicts. Right now, we have Ukraine, Russia. So it's funny. The humans are kind of funny creatures. They repeat. It seems like people forget every 50 years the lessons of history, but that's a discussion for a different day. But as you can see here, okay, here Fed tightened, got loose, and right here they got loose again, and boom, inflation came back, okay? And this actually right here, 74, 73, 74, that's also when the Yom Kippur Wars happened. The United States came out in support of Israel. Saudi Arabia shut their tap off to the United States. Boom, we had this huge oil crisis. It sent, inflation skyrocketing, okay? Fed tightened, boom, but they didn't tighten enough. There was so much pressure. Oh, we're going to head into a recession. The Fed is going to cause a recession. This is going to be a hard landing, this, that, and this. And so guess what happened? They got soft, okay? Kind of like what we see with, in my opinion, I think Jerome Powell is not a Volcker. He's going to get soft. I think he's going to pull back. We're already seeing that. He already pivoted. Okay? So he already started getting a dovish messaging at the Brookings Institute speech a couple of weeks ago. He said, we're going to be doing moderation. And he already, from 75 basis point rate hikes for the last 3 or 4 FOMCs, now he's going down to 50 basis points. Well, now the bond market is pricing in that we're going to be going up only by 25 basis points for the next 2 FOMCs. So we're already seeing that bond market is pricing in that he's going to get, that he's going to start getting looser in the monetary, at least in his positioning and messaging. He's going to loosen up just a little bit. That doesn't mean he's going to cut interest rates when I say he's going to pivot or loosen. It just means he's not going to hike as fast, okay? And perhaps, one could argue perhaps he should have maintained that 75 basis point rate hike, that rate at which he's hiking those interest rates. And perhaps he should have. Who knows? Okay, but that's not what happened. We trade and we base our thesis on what happens, not on shoulda, woulda, couldas. Okay, so here, back in the 70s too, we saw this inflation go down. They loosened a little bit too quickly, and boom, we see inflation coming back again. And it was not until here, right here, we saw Volcker become chairman of the Federal Reserve, and he had to hike rates 64 times. It was like 64 times, okay, had to cause a huge hard landing, caused 2 recessions in a row, all right, caused 2 recessions in a row, but the market actually started going up because of that, because Fed credibility was there. They knew that the Fed was now serious about taking down inflation, and that's what causes the bull market, a cyclical bull market. We are not there yet. We are nowhere near that yet, okay? But that doesn't mean, just because we have a hard landing in the future, doesn't mean we go back to new lows, okay? The lows was actually at 69, or no, was that 70? Yeah, and during 1970, okay? And then it revisited there, overshot it just by a little bit for about 2 weeks in 74, all right? But then when we had the hard landing, well, it wasn't there. We actually are above that, okay? So that doesn't mean we see new lows again just because we have a hard landing in the future, all right? Now, here's, so the point of all of this is inflation is a sticky problem. Okay, so that's why I just wanted to go over that when I'm explaining my thesis here for why I think we're not going to see a recession in 2023. I think we're going to see something even bigger in 2024. 2023, I think, is going to be one of those, like, you know, mini bull markets in between a cyclical bear market. And again, if we look at the 70s, let me go back. If we look at the 70s, the same thing happened here. You know, I would consider this to be a lost decade right here, from 69 to end of the 70s. This was our cyclical bull market, long-term bull. This was a cyclical bear market, long-term bear market. Okay, but in between there, we saw these rallies. Look at that, from what is this? From 63 to, or from here, from 70 to, from here to here, what is that? I mean, the market almost doubled in 3 years, okay? Now, again, the market is a lot faster now than what it used to be. So I think this one is, even if we see a mini bull market, I don't think it's going to last a full year, okay? I think it's going to maybe last a few months, and that's it. And then inflation is going to roar back, and then, you know, and then we're going to see other problems. I think we're going to also see a emerging market solvency risk happening. We had that in 99 or 97, 98 with the IMF Asia financial crisis back in 97, 98. Okay. We had that as well. But back then, inflation was low. Okay. Back then, core was at 1.7 to 2% core inflation. So the Fed was able to add stimulus and inject the markets with liquidity. They were able to inject cash, literal cash, into the markets, okay, to counter this. Well, when that happens next year, I don't think we're going to be at a point where the Fed can do that. Everybody's saying we're going to see this inflation for longer, which I agree with. So in an inflationary environment, is the Fed going to be able to inject liquidity into an inflationary market to help emerging market solvency? I don't think they can. And that is why it's going to be really bad. And everybody says, oh, we've been through EM solvency crises before. We've been through this. We went through it in 97, 98. It wasn't that bad. Yes, it wasn't that bad because inflation was low. But now inflation is higher. What can the Fed do when that happens? Okay? I don't think they're going to be able to do much. They're probably just going to let it crash. Okay? And that is going to be big, in my opinion. And that's going to happen around 2024. Oh, by the way, we're going to also have a fiscal cliff here in the United States back in that time too. Spending is going to go down. Taxation will have to go up 2024. So I think all those confluence, those issues will come together at 2024. And that's when, I mean, this bear market is nothing, I think, compared to what lays ahead if that were to happen. And again, I'm not trying to predict the future. I'm just anticipating what could happen, trying to think 5 or 6 moves ahead like a good chess player would. You can't predict what your opponent's going to do, but you can anticipate based on how the pieces are moving. We call ourselves checkmate trading for a reason, guys, okay? Anything else you guys want to look at? Anything else? Anything else? Oh, somebody from chat is asking me to go back to that chart in the 70s. Yeah, you know, you can go to S&P 500. You can do the US CPI. It's called USC CPI, okay? And you could chart this yourself on TradingView. And, you know, here it is. Oh, this is the daily chart. Oops. Let me go to the weekly chart so you can see more. So, yeah, here it is. Here's the chart. Okay. All right. And again, you know, it's I'll have the recording, so you can also watch the recording as well. All right. Anything else you guys want to look at? Going once, going twice. All right. So then, in any case, we'll call it a day here. We do have our, that wraps up our session of our morning market memo. Our Discord invitation link is in the description below. Come join our Discord. Be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment. Show us some love, baby. All right. So next week, we have our morning market memo, Tuesday, Wednesday, Thursday, same time, 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern time. I will have limited access to internet for the next couple of days. I will be traveling around. So if I don't reply back on Discord quickly or my DMs, just be patient. I'll get back to it most likely on Monday when I get back. Hope you guys trade safe. Be safe out there. You don't have to force a trade, okay? There's patience and discipline. Always remember that. All right, guys, trade safe. Have a wonderful day. I'll see you guys next week.